The main objective of every business is to maximize profit. Except for non-profit companies, all companies around the world aim to generate profit. Therefore, companies should evaluate themselves in order to learn the best ways their assets can be used to generate revenue. This evaluation can be done using a tool called Profitability Ratio. Profitability ratio is a financial tool used to evaluate a company's ability to generate profit through the utilization of its assets. In calculating the company's ability to generate revenue, we would use two types of profitability ratio, which are the margin ratios and the return ratios. In this lesson, we will focus on the formulas in the margin ratios. To do this, we need to understand why we calculate the margin ratios. The margin ratio is used to calculate a company's ability to turn its sales into profit. The sales or revenue of a business is how much it earns from the selling of its product, while the profit is gotten when certain expenses are deducted from the sales. There are different types of profits associated with a business. These profits are the gross profit, operating profit, and net profit. To determine the amount of each of these profits contained in the sales, the margin ratios are used. So how do we calculate this? The formulas are 1. Gross profit margin, 2. Earnings before interest and tax, 3. Operating profit margin, 4. Net profit margin, and so on. To know the gross profit margin, we need to understand what gross profit is. Gross profit is the profit gotten after the cost of goods sold have been deducted from the sales or revenue. To understand this even better, let us see Miss Flora's flower shop. She cultivates and sells flowers. At the end of the month, she sells about 20 flowers, which earns her a sum of 100,000 naira. This is her sales. But in making the flowers, Miss Flora had to buy 20 vases and other raw materials for about 20,000 naira. This is her cost of production or cost of goods sold. So when Miss Flora subtracts the cost of production from her sales, it gives her the gross profit of 80,000 naira. The gross profit margin aims to calculate how much of the gross profit is in the total sales. The formula is sales minus the costs of goods sold divided by the sales. It could be represented in percentage by multiplying by 100%. So if you apply this formula to Miss Flora's business, her gross profit margin would be 100,000 naira minus 20,000 naira divided by 100,000 naira multiplied by 100%. This will give Miss Flora a gross profit margin of 80%. In the general operations of Miss Flora's store, she had to pay for electricity bills. She also had to pay her workers and so on. All these payments summed up to 30,000 naira. After getting her gross profit, Miss Flora deducts the 30,000 naira to get her earnings before interest and tax of 50,000 naira. This is also called the operating profit. The operating profit is the profit earned after expenses as a result of the operations of the business have been deducted. These expenses are administration, selling, distribution, and all other expenses incurred to run the business. The formula for calculating the earnings before interest and tax is sales minus cost of goods sold minus operating expenses. The operating profit margin will then calculate the percentage of the operating profit contained in the sales. Therefore, the formula is operating profit divided by the sales multiplied by 100%. So let us use this formula to calculate Ms. Flora's operating profit margin. The operating profit, which is 50,000 naira, is divided by the value of sales, which is 100,000 naira, and then this will be multiplied by 100% to give Ms. Flora an operating profit margin of 50%. Having gotten her operating profit, Ms. Flora had to pay the tax of 5,000 naira imposed by the government and the interest of 10,000 naira that she owes the bank to get her net profit. The net profit is the profit gotten after the deduction of interest and tax. The formula for getting net profit would be sales minus cost of goods sold minus operating expenses minus tax and minus interest. So to get the net profit margin, this is net profit divided by the sales multiplied by 100%. If we use this formula to get Ms. Flora's net profit margin, it would be the net profit of 35,000 naira divided by the sales of 100,000 naira multiplied by 100%. This means that Ms. Flora's net profit margin is 35%. That will be all for this lesson. You now know the formulas used to calculate the margin ratio for profitability, which are the gross profit margin, the operating profit margin, and the net profit margin. In future lessons, we will look into the second profitability ratio, the returns ratio. Bye!